So we're going to be talking about, I think one of the most important lessons you're going to learn in this class is net present value. So what is net present value? Why do we use it? Net present value implies that the future cash inflows have some kind of opportunity cost discount rate that we use in order to evaluate the project's benefits and costs at a point in time. So we are going to use this discount, these future cash flows. We're going to discount them at something called a required rate of return. You're going to hear these terms a lot: required rate of return, discount rate, the investment rate. All these mean the exact same thing. They're just the rate we're using to apply what that future value of cash is expected to be worth. Right, so it's that concept. Today's dollar is worth less than the same amount of dollars a year from now. If we invest $1,000 today, it'll be worth more a year from now, theoretically. So we want to assume what all those future cash flows, what that'd be worth in today's dollars. And so to discount that future cash flow, we have to use what we'd expect that investment rate to be. And that investment rate is also known as a discount rate, required rate of return. All mean the same thing. Memorize that, write it down on the notes. Subtract the initial amount of invested from the sum of the discounted cash flows. So after we figure out all the future cash flows, we'll subtract out the investments we make. They're saying here a company's required rate of return, often called a hurdle rate. So this has a lot of different names that are used in business. It's typically the cost of capital. That's so the idea here is the required rate of return, or the investment rate, is how much money it would take them to pay off their long-term creditors or shareholders, this cost of capital. Another thought here is what do they need to get in the market? So if they were to invest in their own business, what they would expect to get from just investing in their own business, you'd expect to get in an investment. That's their cost of capital. So, so if a company invests in their own business and expects that the costs would be 3% and that they want to make at least 5% for their investors, their net present value, or their required rate of return, or discount rate, or whatever, hurdle rate, whatever you want to call it, would be 8%. The 3% that they'd expect for creditors, the cost of capital, plus the investors goes into the cost of capital of 5%. So let's go over an example with equal cash flows. So equal cash flows, Fast Track is considering the purchase of a machine costing $16,000 with an 8-year useful life that promises net cash inflows of $4,100. We require a 12% rate of return on its investments. This rate will always be given to you in your initial classes. In the future, if you take graduate level classes or very advanced finance or accounting classes, you may learn how to calculate the cost of capital to apply it, but most of you will probably not do that unless you really advanced your finance education. I only had maybe 1 or 2 classes in my entire educational career that I actually had to determine this rate. So in real life, you'll have to figure out a reasonable rate. And there's a lot of different ways to do that, but we won't be going into that in this class. Let's just assume that you're given this rate. So we get this idea. So let's go to the sheets, net present value. We can make it really easy. This calculation can be pretty difficult, but I want to teach you what you're going to use in real life. So you're more than welcome to use this, especially with online courses on your quiz. It's just a calculation. So you put equal net present value B2. So we're saying the rate. So you equals, the rate is the first piece. And the second piece is our net cash flows, all the cash flows. We just say our rate, B2, comma, all of the cash flows, the sum of the cash flows, and we'll figure out what the net present value dollar is worth. So here we're saying our net cash flows is 4,100, 4,100, 4,100 for 8 years, right? Let me say. So here our answer is slightly different. We get $20,367.32. So we're saying if all these cash flows, $32,800 at the 12% rate, what is that worth in today's money? $20,000. Notice how this is different. So I want to show a few differences here. Sum So the sum of it is 32,000. That's how much you're getting over the next 8 years. But what's that worth in today's dollars? It's worth 20,000. So what is the value lost over the years? About $12,000, right? That it's better to have that money today. Having that money today saved us about $12,000 today. It's a better to have that money today. So that's why we're saying we're discounting each of these cash flows. So the theory is here, each cash flow is worth less and less. That's this rate we see. This rate is, you can get this from a table. When I was in college, you had to do this all from tables, and the tables would give you the discount percentage at a certain rate at a certain year. And so you could see the first year you discount by 89%, then 79, then 70, and so on and so forth. And I'm trying to teach you in real life, you just need to know the calculation. So no, the concept is this year 8 value is worth a lot less than the year 1 value. But then you should be asking me here, why? What is the actual net present value? The net present value isn't this 20,000. We still need to remove difference. You still need to remove our initial investment. So we take our initial investment, 16,000, and then we'd subtract out the net present value from that to get our 4,367. So if we make this purchase decision, this is about the best information we could get. True NPV. This is about the best investment information we can get. We can say if we spend $16,000 today, we will get a net present value of $4,367. So we can now look at a comparable investment and decide what makes us more money based on the similar rate of return. This can get a lot more complex. You can give a different rate of return to each investment stream. I'm not asking you to do that yet, but just be aware this is how the calculation is done, and then we would compare. So let's say we had decision A, an NP, and these are different NPVs, had this 4,000, then we had one that had 10,000, and then one that had negative 5,000. If we could accept all decisions, we'd accept A and B and say no to C. And then if we had to choose between one or another, we'd choose B. That's the concept here. And so the idea here is if it's greater than 0, we will invest in it. If it's less than 0, we will not invest. But obviously we have limited resources, so we should always consider if we can only make a decision between A and B, then we'll take the higher net present value of cash flows. But we should also remember this is an isolated metric. We should also consider risks related to it, costs, all of that, and that we can make more advanced decision making, which you'll get more advanced decision making problems, which you'll get in the future in advanced finance courses, where if we have $1 million and we have these 10 different decisions, which ones should we use? And you can figure it out by optimizing it with net present value. For now, just know that anything greater than 0, we invest in. Anything less than 0, we do not invest in unless there's some kind of constraint. And so here's a good way to, I like these tables. This is how I used to learn it, was this computations of annuities. So what is an annuity, by the way? Go back to my video on bonds. I talk about annuities in detail. But annuities just mean an annual cash flow. So our annuity here would be $4,100. So you have annuity in arrears, or which is an ordinary annuity, or a front annuity. So yeah, I'm sorry, your annuity in arrears or an ordinary annuity. Ordinary annuity pays at the end. Annuity in arrears pays at the beginning. We're just talking about an ordinary annuity here. That ordinary annuity is paying us $4,100 a year over the 8 years, and then our initial investment here. And so I like this visualization because this $4,100 here is worth maybe 90% of $4,100, and we discount it back to this year. This $4,100 is worth even less. We discount it back. So we're taking each one of these cash flows and backing into our initial investment.